Silver hit $94.53 per ounce today, up 41% in just 30 days. Yet mining stocks lagged 25% behind, signaling something unprecedented, a physical takeover of the market. Western vaults are emptying as Shanghai pays a $9 per ounce premium over London prices. If you hold paper silver, your positions could vanish overnight. If you've ever wondered why dealers are demanding $500 minimums while prices soar, this is for you. I'm Finance Evidence, and we uncover the data Wall Street hides. Stick around. The lag warning I'm about to share could save your entire stack. Let's rewind to 2011. Silver peaked at $49 per ounce, then crashed 70% on paper demand alone. Retail investors who bought at the top watched their positions evaporate, not because of fundamentals, but because of paper market manipulation. Fast forward to 2025, and the Silver Institute reports a 150 million ounce deficit, the fifth straight year of deficits. Industrial use has surged 22%, driven by solar panels and electric vehicles. Think of it like supermarkets during lockdown. Shelves bare, prices doubled, panic everywhere. Here's the pattern break that should terrify you. Those paper contracts? They're trading at 150 times the physical supply in 2025. The Bank for International Settlements issued a warning in 2024 about COMEX shorts reaching dangerous levels. We've seen this movie before, but the ending is about to change dramatically. Why? Because physical scarcity changes everything. Analysts noticed something worse in October 2025. COMEX-eligible silver inventories dropped 40% in just 3 months. On January 20th, 2026, the Shanghai Futures Exchange quoted silver at $103 per ounce, while London traded at $94. That's a $9 arbitrage spread, a vacuum sucking Western vaults dry. Here's how the arbitrage plumbing works. Traders buy silver cheap in the West, ship it east, pocket the difference. Repeat. Western vaults drain like the Hoover Dam through a straw. Paper silver represents IOUs on empty warehouses. Physical silver is the real asset, and it's disappearing. The data tells a brutal story. COMEX, one of America's largest dealers, cut output by 50%. The CPM Group reported in 2025 that registered inventories hit critically low levels. One bad delivery month, and futures could gap $20 overnight. The plumbing is broken, and retail felt it first. Dealers entered triage mode. This is where the system quietly breaks. COMEX and JM Bullion instituted $500 minimums for the first time ever. On January 19th, Hero Bullion posted, out of 100 ounce bars, first time in company history. Premiums on generic rounds surged 300% above spot price. You couldn't buy physical silver at the quoted paper price even if you wanted to. Now watch this lag warning carefully. The SGL mining ETF rose only 16%, while silver itself jumped 41%. Miners are being priced as if silver costs $55 per ounce, not $94. This disconnect creates opportunity, but also danger. Here's the domino effect. Physical disappears from retail. Institutions wake up and buy mining shares as a proxy. Liquidity trap snaps shut. On Reddit's Wall Street Silver Forum, the site crashed from traffic as stackers panicked over availability. The IMF's 2025 Metals Reserve Report quietly warned about supply chain fragility. Meanwhile, insiders at Hecla Mining and First Majestic purchased shares last week. They know something the market hasn't priced in yet. But institutions haven't woken up. Not yet. Earnings reports drop in February 2026. Here's the math that will shock Wall Street. All-in sustaining costs for major miners average $20 per ounce. These costs are largely fixed. At $94 silver, that's a 108% profit margin explosion compared to last quarter. Let me repeat that, 108% profit growth in a single quarter. Global mining companies have a combined market cap under $300 billion. That's less than Netflix. If pension funds allocate just 1% to silver miners, that represents a 10% increase in the SGL ETF's total assets. The sector can't absorb that capital without massive price moves. Operating leverage amplifies everything. For every $1 increase in silver prices, miners see roughly $3 in additional profit because their costs stay fixed. Stress test this scenario. Even if silver drops back to $75 per ounce, miners still deliver 57% profit growth compared to 2025. The structural floor from solar demand sits at $80 per ounce according to World Bank commodity forecasts. There are rumors leaking from Hekla's Q4 earnings call, whispers of production costs dropping even further. Yield spreads between mining stocks and treasuries have never been wider. The pressure cooker is sealed. It's a tiny sector about to absorb massive inflows. Prices either explode upward or a liquidity trap forms where you can't exit. The global reset accelerates this process. The Bank for International Settlements warned in 2025 that silver now comprises 15% of global electronics manufacturing and is projected to reach 20% of solar panel production by 2030. These aren't financial games. This is real industrial demand that cannot be satisfied with paper contracts. BRICS nations announced in 2026 they're purchasing 50 tons of physical silver for strategic reserves. China's imports surged 60% year-over-year. This isn't speculation. It's sovereign nations securing physical supply. Watch the de-dollarization domino carefully. Yuan-denominated oil deals are expanding. Central banks are quietly stacking silver without announcing it publicly, avoiding the gold rush attention. Think of the Titanic's hull breach. Fiat currency trust cracks. Physical assets flood in to fill the gap. An Oxford University study from 2024 on critical metals warned this was coming. Sovereign wealth fund flows into commodities doubled in 2025. Credit stress is building in mining companies that can't expand production fast enough. And here's the surprise that broke in January 2026. Saudi Arabia began accepting silver-linked payment structures for certain oil contracts. The liquidity trap closes next. SIL's daily trading volume averages $40 million. If a $100 billion fund decides to enter, they need 5 times that daily liquidity. Prices gap 50% before they can build a full position. This isn't theory. We saw the exact same backwardation in 2020 when contracts were cash settled because there was no metal to deliver. High-frequency traders will front-run this move. The moment volume spikes, we'll see 30% daily moves like uranium experienced in 2023. Picture a crowd crush at a narrow door during a panic rush. Early birds feast on the opportunity. Late arrivals get trampled. Stackers are already on wait lists at major dealers. The SLV ETF saw massive outflows as investors lost trust in paper structures. Human behavior shifts from "should I buy" to "can I even get it?" Fear drives the next phase. Late retail will chase $150 silver while smart money positioned months ago. The phases reveal the play. Let me break down exactly what's happening and what comes next. Based on finance evidence data analysis, we're currently in Phase 1. Silver holds above $93 and shows no signs of breaking down. February quarterly earnings will show profits doubling across the sector. Analysts will scramble to upgrade ratings, chasing the move they missed. Phase 1 is happening now. The trigger is silver holding above $93 per ounce. Target producers like Hekla Mining and First Majestic Silver. These companies offer 2 to 3 times leverage to silver prices. We're watching this phase unfold in real time. Phase 2 activates when premiums exceed $10 per ounce over spot. We're at $9 in Shanghai already, almost there. Target silver developers like Discovery Silver. These pre-production companies offer 5 times upside potential as the floor rises beneath them. Their projects become economically viable at elevated silver prices, and acquisition targets emerge. Phase 3 ignites when SIL sees 10 million share daily volume, roughly triple the current average. This signals institutional panic buying. Target exploration companies at this stage. This is mania territory with 10 times potential, but it's also the highest risk. Junior explorers with legitimate deposits will see insane multiples, while scams will proliferate. Due diligence becomes critical. Phase 4 is your exit ramp. When silver crosses $120 per ounce, rotate into royalty companies and streaming firms like Wheaton Precious Metals. These companies provide downside protection while maintaining upside exposure. They're the smart money's final destination before the inevitable correction. Math beats narrative. Every bull market follows this pattern. Discovery, acceleration, mania, exhaustion. The difference this time is the physical shortage underneath it all. Paper illusions end. Physical rules. We've built a financial system where 150 paper claims exist for every ounce of physical silver. That system functions perfectly until everyone asks for delivery simultaneously. We're approaching that moment. Western vaults are draining at an accelerating rate. The arbitrage to Shanghai will continue until price equilibrium is reached or supply runs out entirely. Given that mining production takes years to ramp up and industrial demand keeps climbing, supply won't catch up anytime soon. The mining sector's market cap relative to potential demand creates a mathematical certainty. Either prices rise dramatically or the market breaks through cash settlement and contract defaults. Neither option is good for paper silver holders. Central banks diversifying into physical metals, BRICS nations securing supply, industrial demand from the energy transition. These are structural, multi-decade trends. They don't reverse because of a Fed rate decision or a Treasury Secretary statement. If $94 is the floor rather than the peak, we're witnessing the early stages of a generational wealth transfer. Those who understand the difference between paper claims and physical assets will benefit. Those who don't will learn an expensive lesson. The phase one question you must answer: do you enter now or wait for a crash that may never come? Every previous silver bull market saw corrections of 30 to 40% before the final surge. But every previous bull market also had available physical supply. This time is structurally different. Finance evidence will dig deeper next episode. The East-West Vault drain exposed. We'll show you exactly which COMEX warehouses are bleeding inventory, which Shanghai warehouses are filling up, and what the shipping data reveals about the timeline to crisis. Here's my final question for you. Do you protect your stack first, or do you trust the dip? Comment below with your strategy. We'll evidence it all, no matter where the data leads. The paper silver market and the physical silver market are diverging. Only one represents reality. Choose wisely.